Have you ever wondered why you are unable to stick to your own rules, even after promising yourself to follow your rules each day before you start trading? Every day you tell yourself that you won't shift your stop loss, or that you won't take profits before price hits your target, and yet, you fail to adhere to these promises you've made to yourself. The inability to stick to your own rules arises from the mental impact your previous trading journey has had on you so far. So how do we tackle this issue? Watch the video till the end to find out. Trading is a uniquely challenging activity that exposes individuals to significant psychological stressors. The uncertainty, volatility, and potential for financial loss make it emotionally demanding. In such an environment, traders may find it difficult to establish and adhere to a set of rules for several reasons. One of the primary psychological barriers to creating rules in trading is the fear of constraint. Traders often see rules as limiting their ability to act spontaneously and capitalize on emerging opportunities. They believe that rules restrict their freedom to make impulsive decisions, which they perceive as advantageous in the fast-paced world of trading. Flexibility is highly valued in trading, because markets are constantly changing. Traders who resist rule creation often argue that flexibility allows them to adapt to evolving market conditions more effectively. They fear that rigid rules might cause them to miss out on potentially profitable trades. Overconfidence is a common cognitive bias that can lead traders to believe that they possess superior knowledge and skills, making them exempt from needing strict rules. Such traders often think they can outsmart the market through intuition and instinct, disregarding the need for structured guidelines. Trading provides a sense of autonomy and control, which some traders find psychologically comforting. They believe that discretion in decision-making allows them to express their unique trading style and personality. Consequently, they resist creating rules that may seem impersonal or mechanical. So, how does our inability and unwillingness to create and follow rules affect our trading? The reluctance to create and follow trading rules can have severe consequences for traders. These consequences extend beyond financial losses and can affect a trader's emotional well-being and long-term prospects. Trading without rules exposes traders to heightened emotional stress. The absence of a structured framework can lead to erratic decision-making, resulting in anxiety, frustration, and emotional exhaustion. Traders who lack rules often experience inconsistent performance. They may have periods of success followed by significant losses due to impulsive decisions or a failure to stick to a well-defined strategy. Creating and following rules enables traders to analyze their performance objectively. Without rules, it becomes challenging to identify and learn from mistakes, hindering personal and professional growth. Uncontrolled risk-taking and emotional trading can lead to significant financial losses. Traders who resist rule creation are more likely to experience capital erosion, jeopardizing their trading careers. Repeated trading failures resulting from a lack of rules can erode a trader's confidence. This loss of self-assurance can lead to a downward spiral, further impairing decision-making and performance. Thank you for scaring us, Mr. Now tell us how to deal with these issues. To overcome the reluctance to create and adhere to trading rules, traders can take several proactive steps. Traders should educate themselves about the importance of rules in trading and the psychological biases that hinder their development. Awareness of these issues is the first step toward change. Traders should establish clear trading objectives, including risk tolerance, profit targets, and time frames. These objectives form the basis for creating rules that align with their goals. A comprehensive trading plan should include entry and exit strategies, risk management rules, and guidelines for handling various market scenarios. This plan should be well documented and followed consistently. Traders should rigorously test their trading strategies and rules using historical data or paper trading. This process allows for refinement and optimization of the rules. Accountability is crucial for adhering to rules. Traders can seek support from mentors, subscribe to our channel, trading communities, or even professional coaches who can hold them accountable for rule adherence. Regularly reviewing and evaluating one's trading performance against established rules is essential for improvement. This process helps identify areas that need adjustment or refinement. Developing emotional discipline is an ongoing process. Traders can benefit from practices such as mindfulness, meditation, or cognitive behavioral techniques to manage emotions effectively. Discipline is a major factor that plays a role in your trading journey. While we may learn the theory and call ourselves an expert, real trading success will come only if you are disciplined and are able to follow your own rules. Staying consistent in following your rules is important, and if you want to learn how to be consistent in your trading journey, click on the video given below.